And following up to that straddle discussion, in which we pointed out, let me go back to a long straddle here. Let's go into the search. Ziad says, but if the stock doesn't move or makes little movement, then you lose the whole amount on the long straddles. And let's see, what was the rest? Yeah, and you would lose the whole amount, and that's true. Okay, this again, I covered this a little bit, Ziad, when you asked the question, but this again is why. Oh, I've got this set up wrong. Okay, Johnson & Johnson, that's not going to move. J&J, Johnson & Johnson's at 149. Looking next week, 24th of January, 150 call, 150 put, total cost of 325, earnings coming out on 122, 5 days away, confirmed before market. Okay, so going back to the straddles very quickly here, this would be the straddle I would likely enter on Johnson & Johnson if I was going to do it. Break even is at 146.75 on the downside, 153.25 on the upside. It's about 3 points, 4 points up, and about 3 points down. Okay, so what Ziad is saying is that we know you're paying into higher volatility, but if it only moves 2 to 3%, you're probably pretty close to this full loss. And if it just goes up to 150, you're at the full loss. You're absolutely right. So this goes back to what I was saying, Ziad. With the structures, long straddle, long strangle, this is what we prefer. But again, we're trying to target positions that in general have something along a 5 to 7% movement on average at least. And if we get that extra surprise 5% of the time, fantastic, that's what we love. But something on Johnson & Johnson has an average of only a movement of maybe 2%, 1.5%, 3% around earnings. You're right. I'm probably not entering this straddle because of the position. You say this might be a good opportunity to do the straddle because if I go further out in this case, I'll have a lower cost basis. I'm sorry. You go further out with a short strangle. My apologies, Ziad. You go out with a short strangle, you're playing into this higher volatility. Right, but these are only going to be worth 10, 15 cents. And what if this happens to be the surprise? What if the earnings are factoring in the $1 billion or so payout or hundreds of millions of dollars payout Johnson & Johnson has, and it slips 15%? My risk is infinite to the downside and to the upside. I just don't think it's worth it. Okay, but you're right. And that's what earning is addressing, and that's part of the structure is, can doing this be profitable long term, as opposed to just doing the short, or just the short out of the money strangle, or the buying the strangle, or buying this a month ago and then waiting for the volatility to increase and closing before the earnings and taking a 5-10% profit on an volatility collapse, excuse me. That's all the things earnings is testing and doing and proving that, yes, this structure with the right stocks and with the right approach can still be profitable, even knowing that sometimes you might take an 80% loss. Going back again, which is why not just one earnings straddle, but anything you're allocating to earnings straddles should not be more than 5 to 10% of your total portfolio, because you could realize those losses. That's an outcome. That's a potential you got to be prepared for. What did I say? Lottery ticket. Lose it all, or wow, get an unexpected surprise. Okay. and Sam says, yeah, I don't like weekly straddles. I go longer so I can do adjustments. And that's a good approach for something that's a trade. This isn't a trade. It is a trade, but it's an earnings play only. That's what we're talking about here. That's what I talk about when I talk about the earnings straddles. Earnings only, not looking to adjust, not looking to manage. Lottery ticket, small amount of money, don't hit anything, you lose it, get that surprise. Hey, Merry Christmas early to us in January. Late Christmas to us in January. That's what we're looking to do. So, but Ziad, you're right. This could be a potential outcome. And the idea is to create a structure and a plan, trading plan, for this small portion of your portfolio, if you decide to use it, that can still be profitable long term. All right. Okay, so Jerry asked to follow. It's not related to married puts, really. It's kind of related to this. But Jerry says, what do you think about doing a married neutral position of a long call that is up 30 to 40%, and then purchasing a long at-the-money put to give you a straddle-looking graph that is bulletproof? Yeah. In fact, if you're tracking a long call in the portfolio that has a 40 to 50% gain, you'll likely see two rollout opportunities. So I'm just tracking a long call. We're at 150, 149. All right, let's go to the portfolio. Oh, that's a better idea. Let me switch. I know it's not here, but let me enter a long call. Back on the 17th or so, the index was at 42. I'll give myself some time. Let's go to Valentine's Day, expiration. Let's say when the index was around 42 where I bought it, let's say I bought the 43 call for $1.40. Oh, okay, let's say $2.20. $1.40 would have been way too cheap. And let's say we did this on 12 of 2019, Jerry. Okay, so depending on what's available, of course, and depending on what's there, so I'm at 47% on this call. Here's that index call I just entered. These aren't the real prices, but I put 220 in. Probably would be a much higher gain, but I put 220 in, so we have 47% gain on this long call. Now, when I go to position actions and position analysis, it might show me opportunities to create a diagonal to hedge some of the costs on the position. It might tell me I can roll to a higher strike price to drastically lower the cost basis, and there might even be a bulletproof structure in here as well. I don't see one right now, but taking the profits off of my call right now that I bought at 220, could sell at 310, I could buy a higher strike call for a smaller amount of money and have less exposure, 95-cent risk with still limited upside. Doesn't show me a diagonal right yet. So it's probably looking for a good premium, but I'm probably too short-term in. 28 days in, yeah, and probably too short-term. If this was 30, 60 days out in time, I'd probably see a diagonal approach to this position. That would be one of the rollout opportunities. And if it's far enough out, you might see a rollout opportunity to do what you said. So I've got a 47% unrealized gain. The stock has moved up. What am I doing? I'm holding a 43 call that's at 45.40. I want to lock in some gains, but I'm at February. I'm shorter term here. So I've got to go, I'm not going to go further than that. I'm going to stay right at February. Jerry's saying, hey, buy an at the money put. Well, that's where you're paying the highest time value, remember. In this case, now you've created what's known as an in-the-money long strangle, only carrying half the risk we started off with. But remember, I had to add into the time value and add into the risk. So if it pulls back, I could still potentially realize half the loss of what I paid into it, but I've got more into the position now. It's a good idea if you can have no risk to bulletproof it with the put. What you might be better off doing is just moving the call up. You know, I started out of the money on the call when the stock was at, and I don't have 100% gain. This really works best when you have 100% gain in the call. But I started out of the money. The stock was at 42. If I sold to close this and took the $1.40 profit and then bought a 47 call that was only $1.40, I'd now have a bulletproof call at the 47 strike with infinite risk to the upside. Without paying the extra money for the put, I might be able to just move this up. That's what I was looking for in the position analysis, Jerry, to see if we would have had a bulletproof long call by just moving it up as well.